Welcome to the Daily Drawdown, where today the pressure points are chips, power, pricing, and positioning. The market's biggest story isn't just AI demand anymore, it's whether the cash flows, power supply, and end customer budgets can keep up with the build-out. TSMC put up huge numbers again, with profit up about 77% and sales up roughly 36%. But the stock still sold off because the bar was already set high. The bigger takeaway is CapEx scale. TSMC is adding another $100 billion for US fabs, and even with different estimates on the cumulative total, the message is the same. This is a massive, long-duration build cycle. That matters because chips now drive an outsized share of index earnings and earnings growth. When one industry carries that much of the market, any wobble in demand timing, margins, or supply can hit indexes much harder than usual. What to watch next is whether hyperscaler spending keeps converting into real end demand on schedule, because forecasts for AI infrastructure spending into 2028 are enormous and leave very little room for execution misses. The sharper stress point inside semis is memory. Micron, Western Digital, SanDisk, and peers have dropped hard, and the speed of the unwind says investors are repricing scarcity, not just growth. The concern is simple. Current DRAM and HBM profits depend heavily on constrained supply. If capacity expands fast enough to loosen pricing, margins can fall a lot faster than revenue headlines suggest. That risk is serious enough that market participants are looking at hedges against falling DRAM prices. When buyers start hedging the input, it usually means they don't trust today's pricing regime to hold. AI demand is still strong, but the bottlenecks are showing up in product cadence and economics. Google's Gemini 3.5 Pro reportedly missed its planned launch, and Alphabet has been tied to external compute leasing to bridge capacity gaps. That tells you compute availability is still a real constraint, even for the largest platforms. Owning the stack from data to inference remains a real advantage, but only if the organization can move fast enough to use it. At the same time, pricing is shifting. Enterprises increasingly want outcome-based billing instead of paying by token, because they care about business results and don't want teams optimizing prompts just to manage software spend. There's also a budget signal to watch. IBM's late quarter CapEx pause and similar commentary suggest the first wave of AI deployments may be running into normal procurement discipline, which could make spending more selective from here. Even if compute demand holds, electricity is becoming the binding constraint for data center growth. Operators are running into power availability limits before they run out of appetite for GPUs. That's pushing the market toward behind-the-meter generation, bring your own power models, and more attention to water use, permitting, and local regulation. It's why industrial infrastructure names like Schneider Electric and Trane keep coming up in this trade. The practical read-through is that AI exposure is broadening. It isn't just semis and cloud anymore. Grid equipment, cooling, backup generation, and retrofit capacity are becoming critical parts of the value chain. Netflix's quarter raised more questions than the headline might suggest. Free cash flow was about $1.5 billion, roughly $1 billion below analyst expectations, which puts more focus on actual cash generation and on how aggressively buybacks may support the stock. Engagement growth looked weak, with first half 2026 viewership up only about 2% year over year, and Netflix is cutting engagement reporting from twice a year to once. Analysts read that as a transparency reduction at a time when subscriber health matters more, not less. The ad tier is still the main growth lever, and revenue there is expected to grow fast, but ad yield per user is still low. That means there's work to do before the ad business really supports the kind of margins investors want. Netflix is also leaning harder into live sports. The strategic logic is clear, but if live rights costs rise faster than engagement, margin pressure follows quickly. Underneath all of this, the market is rotating away from the most crowded AI and momentum trades and toward industrials, financials, healthcare, and other steadier earnings profiles. That rotation is happening with retail crowding still elevated, margin debt up sharply year over year, and single stock volatility far more extreme than the index level implies. In plain English, concentrated bets are more fragile than they look if you're only watching the S&P. Options positioning adds to that risk. Expensive upside calls in major tech and high dispersion across single names create a market where reversals can be sudden and violent, even if the benchmark barely moves. South Korea's regulator stepping in to halt new single-stock leveraged ETF listings after severe retail losses is a useful warning sign. When regulators are cooling leverage at the edge, it usually means speculation already ran too hot. Outside tech, United Health posted a strong beat and raised guidance, helped by a lower medical cost ratio and operational gains tied partly to automation in claims prior authorization and fraud detection. That matters because it's a reminder that AI doesn't have to show up as a chatbot to drive earnings. In some sectors, the highest value use case is just cleaner workflow, lower leakage, and better unit economics. United Airlines also beat and raised full-year guidance on fares and capacity discipline, but it flagged a major fuel headwind, with fuel costs running roughly $6 billion above earlier expectations by year-end. So the read-through there is mixed. Demand and pricing are holding up, but input cost exposure still matters a lot, especially if energy volatility picks up again. On energy, tensions around Iran are keeping military and supply risks in focus, but large crude inventories on the water are helping cap the immediate price response. That's why the geopolitical risk premium hasn't translated into a straight-line oil spike. Longer term, the U.S. LNG build-out still looks structurally important for growth, jobs, and export capacity, while alternative regional routes are gradually changing the map for Middle East energy flows. For rates, the debate is still whether any further tightening comes through policy rates or balance sheet tools. Either way, higher for longer has helped banks through net interest margins and is feeding expectations for more regional bank consolidation. The practical watch list is straightforward. Chip and AI names need proof that demand converts into durable cash flow, and the broader market needs to show it can absorb rotation without turning orderly de-risking into a sharper unwind. That's the brief for today from the Daily Drawdown. The main trade to watch is the gap between AI ambition and the physical, financial, and customer budget limits underneath it. This episode was generated by Podkey. Create your own at podkey.fm.